It's Brian Preston, the money guy.
Tax codes on the individual side, they're dropping for most of us. We still have 7 tax brackets, but they all kind of came down a little bit. We have the, 12%, 22, 24, 32, 35, 37. Those are a little different than what they used to be.
About 2%-ish lower than current brackets.
So somewhere between 1 to 2% less than they were. So all tax brackets getting a little bit of a reduction on that. If you're a higher income person, you used to know that a lot of your itemized deductions were getting phased out. It was called the P's limitation.
That's right.
And if the income amount was, for individuals, it was $261 for individuals, $313 for married couples. You started noticing that about 3% of your itemized deductions over those thresholds were starting to go away. That's gone. So if you're a high income person, you itemize, you're going to get to keep that stuff. That actually is going to probably result in you getting another 1% off on your income taxes, because what it really was a secret income tax on wealthy people. The top tax rate was 39.6, but because you lost all your itemized deductions, it pushed the rate well over 40. Sure. So that's just something to be aware of. We've already talked about the fact that really the losers on this thing, I think all people, especially taking into account the P's adjustment, all married individuals, from a tax rate perspective, got a tax cut. You might have lost some deductibility because you live in a high income, high state income tax situation, but you did from a tax rate, you'll save money. It's the single individual, somewhere around 180 to 200,000, all the way up to 400,000. Your tax rates, you're kind of caught in that limbo land where you might be paying a little bit extra. Marriage penalty is now only for the super high income type people. I'm talking about people making over $600,000 a year. Most people, because remember what the marriage penalty is, that meant if you looked at the tax rates for an individual person versus a married couple, they weren't 2 times. I mean, You'd think that you just take the individual rate and multiply it by 2, and that would be the same for a married couple. It wasn't always that way. They didn't line up perfectly. Now they do pretty much line up all the way up until about $600,000 that, there's no penalty whether you're married or single.
Follow, yeah.
So that's an important thing to think about. Kiddie taxes. In the past, once your income for your kids, if they had investment income, not earned income, like if you go get a job, your earned income was always going to be subject to your income tax rate. But now that once you, had unearned income, investment income and, interest, dividends, capital gains and things like that, up until $2,100, you got to take it as your own income. But once it was over $2,100, all of a sudden it went to the high tax rate of your parents. Well, now it's just going to be tied to the trust tax rates, which caps out right at 37% once that income's over $12,500. I don't think there's a lot of kids that have income
I think the math
over $12,000.
Had to be like a $400,000 account for a kid or something like that.
So I think if anything, it probably makes things a little easier, but I don't think that has a huge impact to most people. A lot of you are probably surprised to find out there's not much impact on the capital gains, qualified dividends rate. Right now it's 0, 15, 20%, depending upon where your income is. Those rates didn't change. Matter of fact, it's so weird that even though they changed, they toggled around with where those income rates hit, they didn't change it on the capital gains as well as the dividend rate.
So it's a little more complicated.
So there's a little separation, might have added a layer of complication, but otherwise it's all the same on that. Still have the 3.8% medical surtax that's out there as well. So that's something to consider. Merging the personal exemptions, as I think we mentioned it briefly earlier in the show. Standard deductions are, majority of you are going to probably take a standard deduction, but when you took the higher standard deduction, they also merged in your personal exemptions. The good news is that, and this kind of rolls into it, is that you are going to get a child tax credit for your kids under 17. And a lot of you probably know, once you were a married couple making over $110,000, you didn't get to take that. I mean, it kind of started, it was gone. It went away. They pushed that number up significantly. I think it's $400,000 now.
200 for single, 400 for married.
So if you're a person making if you're a married couple and you have these, you hear that the easiest way to save taxes is to create a tricycle motor. And then when, you create a tricycle motor and you start having a little bit of success where you made over $100,000 and you realize, well, wait a minute,
I don't get that child tax credit
I don't
anymore.
get that. Now you get it. So at least that tricycle motor is going to start creating a little more of a tax benefit for you. That's a pretty big one.
And they doubled it from $1,000 per child to $2,000 per child, and up to $1,400 of that $2,000 is refundable if you're a zero taxpayer.
That is correct. So that's a big benefit for people is that. And I think that's because I've seen a lot of articles that have been somewhat confused in the fact that they say they made a big deal out of the personal exemptions are rolled up into the standard deduction. But here's the good news is if you have children under 17 is that it's a child tax credit. Credits are so much more powerful than deductions because credits are a dollar for dollar reduction in your taxes. If you owe, if you have $1,400 due in taxes, but you have a kid, I mean, it could bring down that $1,400 to zero,
right.
Whereas that deduction might not do that. It just lowers your taxable income. So make sure you understand that. I also thought it was kind of cool. There's now also a credit for people for married couples up to $400,000 for not just your children under 17. It could be your adult children. If you're providing over 50% of their, financial, you're covering their expenses. It could be an adult parent that you might be caring for too. Sure. There's a tax credit for $500 for the people who are even, over the age of the 17-year-old. So that's a pretty powerful thing. Itemized miscellaneous deductions.
They're gone.
They're toast.
Yep.
Mortgage interest deduction. This is a big one that I think, we ought to talk about is that if you currently own a house, nothing really changes on that, but when you buy a new house going forward, if the mortgage is bigger than $750,000 for a married couple, $375,000 for a single individual, won't be deducted. Any portion over that will not be deductible.
Whereas current law is $1 million.
Yeah, $1 million. So that's a big change. The other thing that's pretty big is 2018. All of your home equity lines that, people were using back in the 90s and 2000s to buy cars, and as well as some people using them for the right purpose of improving their house, won't be deductible anymore. So home equity lines probably going to go the way of the dodo bird. So, you need to get a plan of action to get rid of those home equity lines as fast as possible.
Are those grandfathered in also? Do you know that? Or if you're currently deducting?
That's a great question. And I'm going to be honest, don't know the answer on that one.
Sure.
So that's something that we'll need to look at. We talked about the $10,000 cap on state and local income taxes, mortgage interest deduction. We've talked about charitable deductions are expanded.
Yeah. They increased it from 50% of AGI up to 60% of AGI.
I don't think there's a lot of people that are doing more than 50% of their adjusted income to charity. But there probably are people who donated houses and other things, so there's an increase there. So if you have some carry forwards, they'll probably get loosened up.
Sure.
Medical expenses, we kind of talked about how they went from 10 to 7.5%. That's an important thing. Casualty losses are now limited only to federal disaster relief areas. It's not something like you can just claim a tree fell and go through the calculation. The casualty losses is gone unless it's something the federal government deems. Miscellaneous itemized deductions, made sure I got the miscellaneous in there, is going away. 529 savings plans, we've told you, those things have gotten turbocharged, especially if you have kids in private school. Take that in conjunction with the SALT limitations on the state income taxes and local taxes. You need to pay attention to those specific state benefits for your 529. Take advantage of those things. I was also excited. ABLE accounts, which are closely related to 529s, just they're designed for ABLE accounts, or 529A accounts, which are designed for special needs. You can roll a college 529 into a 529 ABLE account without tax issues. Now, there are limitations to how much you can do each year, so it might take a few years to get in a full transfer, but it's still something to look at. I thought alternative minimum tax. This is a big one. It has gotten much better. There was an exemption from the old rules were $55,000 for individuals, $86,200 for married couples. It's now going up to $70,300 and $109,400. So that's a big benefit. Yep. But here's even the bigger benefit, I think, is that there was an exemption phase out, meaning that if your income was up too high, they'd start phasing out your ability to even have an exemption for alternative minimum taxes. That phase out was from 123 to 164 in the old rules.
Right.
Now it's $500,000 for individuals, $1 million
wow.
for married couples. So it's going to be much harder, I think, to get into alternative minimum tax. That's a very good thing. So that means people who used to somewhere between $150,000 and $600,000 of income, you're going to be happy to see you might not have alternative minimum tax as much. Big one that, just people want to know because you own a small business and you might have pass-through income. This is one that I know I was watching. I have a lot of clients who are doctors and professional people, and they were like, this is hopefully going to be a huge benefit to us small business owners that we're going to get this deduction on our pass-through income. Well, they did come up with something. The way this is generally going to work is that your pass-through income is going to have a 20% deduction off of it. So only 80% of the income will be deductible. So a lot of you are like, hot diggity dog. That's going to be awesome. Before you get too excited, know that there's a lot of exclusions in this thing. Because here's what I think the government was worried about. They don't want people taking their wage income for the personal services they're doing within these businesses and then just calling that business income and then excluding, taking this big tax deduction. So they got busy on writing lots of exclusions. This is going to be probably the most complicated part. If you are a small business owner, you need to talk to probably a professional, an accountant, because they wrote in here, I was looking for the terminology. They wrote in, here's all the exemptions for professional fields. Health. So here's all of our doctors gone. Law. There's all your attorneys. Accounting, which all the CPAs. Actuarial sciences. Performing artist. So I guess Lady Gaga is not getting this either on her business. Consulting, that's very wide.
That's pretty broad.
Athletics, financial services, and any other trade or business where the principal asset of the business is the reputation or skill of one or more of its employees. Man, that is a catch-all of catch-alls.
That's a big one.
So you can see that they're basically excluding out a lot of things where it's based upon your skill set, your talent. Now, I will tell you, if you're a lower level partner at a firm, and maybe you're a single individual whose income, the phase out is at $157,500 for individuals, $315 for married couples, where those personal service exemptions don't come into play until you exceed and they just start to phase out at that $315. So somebody who's, makes $415,000, $315 to $415 as a married couple, you might still be able to use some of this, but there is a phase out that kicks in. But once you make over that $400,000 level for a married couple and you have pass-through income, probably not getting that 20% deduction. Sure. So it's definitely something you ought to consider. That's why there's a lot of people saying that there's going to be people that become C Corps. Right. But I think about that. Remember, when you're a C Corp, it's great you get the 21% tax rate.
You get double tax. But
every time you pull a dividend or a distribution, that's considered a dividend, you're going to pay, you could be paying 23.8% based upon where your income is. That's higher than the 37% bracket. So, there's probably going to be some play there, but I don't know if it'll be as widespread as some of the articles I've been reading out there have been. Let's see. I've talked about the estate taxes. Oh, let's talk about some things that didn't make it in that everybody was worried about. These are more boogeymens that were, and this is probably a great way to close out the show, Bo, for all of our nerds that hung in there with us. A lot of people were worried about certain things that were going to be done away with. I've already kind of dispelled one of them with the medical expenses because that actually got better. Another one for investors was maybe this is only financial advisors and really financially nerdy people were thinking about FIFO provision, whereas it was going to make it where your basis in your investments, right now you have some play on that. You determine when if you want to donate assets or if you want to sell them, you kind of determine which ones you're selling at the time to give yourself the best tax situation. The government considered doing what's called FIFO, which is first in, first out, is an accounting term, where that oldest security, which likely is the most appreciated security, was going to be the first one you had to pay taxes on.
That would have been a big issue.
That would have been a big deal because it would have probably taken out our ability to do loss harvesting and other cool things we do. And you probably take advantage of too, guys out there, watching this. So that's gone. That did not make it through. There's also, I'm a big Tesla person, like Tesla, and a lot of people were worried about, are the electric car tax credit, is it going to be in there? or is it going to be killed like it was talked about in the House bill and so forth? It actually silent. So by the sheer fact that nothing was done on it, the current law continues on. So those tax credits still exist. Same thing, teachers. Right now you get to take an adjustment to income before you get to, itemized deductions, everything else. It's just if you have $250 for school supplies, that was rumored that was going away. You still get to take your $250 of school supplies. There was also the adoption assistance tax credit that was talked about being done away with. That's still out there. I saw a lot of interviews. It's funny how little things caught the press's and the media's attention. Graduate students who were teaching and then getting a subsidy of their tuition, that was going to be taxable under one of the proposals. Now they were silent on that. So if you're doing graduate work, still teaching in college, it's going to be a tax-free benefit for you. That continued on. Trying to think if there's anything else that. Oh, big one for real estate, because I think about my home builder. My home builder, and I think a lot of other real estate professionals do this, because they don't have to pay all the real estate. They don't have to pay the markup of building a house plus the real estate commissions if you have a real estate agent license as well. They get to cut a lot of that stuff out. So I know a lot of people in real estate will live in a house for 2 years and then they'll move to another house, and then the appreciation on that house, they just pocket it because, under the current rule, for a married couple, up to $500,000 is tax free as long as you lived in the house 2 of the last 5 years. But one of the proposals was put out there was going to change that to 5 of the last 8 years.
Wow.
So people got to live in it much longer. That got left out. So all you home builders, you're going to be able to continue to play the game of tax-free income. So that's pretty incredible. Individual mandate was repealed, but it doesn't kick in on the healthcare side until 2019. Sure. Alimony there's going to be a lot of unhappy people who are getting divorced, because it used to be, once again, we all love that it's deductible. So at least if you had to pay alimony, you're like, well, I get to deduct it and my former spouse gets to put it as income. That's not going to happen. Now it's just you pay alimony, the tax deduction and the tax income is going away. 1031 exchanges, like-kind exchanges, are only going to be available to real estate. So all your art and all the equipment that people were using that's going away. Moving expenses, gone. So if you're thinking about move before the end of the year. It's not happening. I'm saying that only joking with tongue to cheek, but moving expense deduction is going away. There's going to be an increased depreciation for business cars, which I thought was kind of interesting, because remember, a lot of this for businesses, they're going to be able to expense instead of taking depreciation over several years. They're going to be able to expense a lot of their capital purchases pretty quickly. Here's a big one that nobody's talking about, and I think if you're a small business owner, crack down on business entertainment expenses. You can still deduct meals expense at 50%. So when you take a client out to business, out to eat or something, you take it a 50% deduction. It's not 100% deductible, but 50%. But the entertainment side, if an activity is generally considered to be entertainment, amusement, or recreation, no longer deductible.
Oh, wow.
So that's a pretty big one.
Can't take them out to a baseball game or concert anymore.
Yeah, so I mean, those are, I think that's, hopefully we nerded it. How did I do? Are we over 15 minutes? Are we over an hour?
We're not quite over an hour yet.
That's great. Okay. Whew. I'll take a deep breath.
I think the big takeaway here is we're not really going to know how far-reaching these changes are, and truthfully, we're not going to really know the true impacts till we get through a few tax seasons. But this at least gives us some meat to play with, some stuff to chew on, some stuff to digest, and some ways to think about how we can make small adjustments in 2018 and beyond to start trying to have a more optimized, more tax-efficient financial situation.